Good afternoon. This is the last session, as you might know. In fact, we're wondering about how we can incentivize you to stay awake. This is the last session on Friday. First of all, let me thank Cyber and the Cyber team for organizing such a timely conference. The panel that I'm going to moderate today is sponsored by the Center for Financial Policy that I direct. Apparently, there's an introduction of CFP this morning, and I was not here. But I think the main show is really of cyber. So we're going to shift our discussion away from technology and innovation in China and India to emerging market finance. So there's going to be a finance. And then if I have time, after these two panelists speak, I'll give you some entertaining introduction to African finance, because there was very little mention of Africa today, right? So why don't we move on, and we have two leading experts in emerging finance. The first is Stijn Claessens. He actually leads the financial sector division of the research department of the IMF. Stijn was a professor of international finance policy at the University of Amsterdam. Prior to that, he was actually at the World Bank. Stijn actually is very well published. He has published in the leading journals in finance and economics, and is an expert, a leading expert in emerging finance. Our second panelist is Professor George Allayannis. I always get confused in terms of pronouncing his last name, but I have known him for a long time. He is a full professor of finance at UVA, Darden School. And he actually spent in 2005, 2007 on Wall Street, Citigroup, and he has actually a lot of exposure relating to his, risk management issues pertaining to emerging finance. And his main research is on international finance. So we're going to begin with Stijn Claessens, and then we'll go to Georgios. And then if there is some time, I'll give you introduction to African finance, and then we'll open up for questions and discussion. Stijn.
Okay. Well, thanks very much, and Lemma, thanks for inviting me. It's a pleasure to be here. So I'm going to talk on, the slide is about, it's either a world where the light is coming up or where the darkness settles, and that depends on your perspective, of course. If you think of the emerging markets, the light is coming up. If you think for the advanced countries, the light may be going down, the sun is setting. So my talk will be a little bit of a mixture of these two perspectives. So what I wanted to do is give you a little talk of what's different in the crisis as we have seen in advanced countries now. And actually it links very closely to emerging markets, because a lot of the lessons we've learned from previous crises in emerging markets really apply to the advanced countries. And I wish more of them would have been applied. But it's also relevant for what's happening in advanced countries for emerging markets, because advanced countries are going through many financial reforms. They're going to affect emerging markets in many ways, in terms of the capital flows that they're going to be receiving, in terms of the way they have to reform. And of course, emerging markets will give some counterbalance, but nevertheless, at this point in time, still advanced countries are very much driving it. And I will conclude with something about where finance is in emerging markets itself, in terms of the reform agenda and what more needs to be done. So a little bit on the crisis. Now, all of us have lived through this. What was different this time is a question that not everybody always asks, because they think this one was very different from all the ones that I've seen before. I kind of beg to differ with this perception, because I think this crisis was very similar to the ones at least I've seen before in many emerging markets. So I think there are many lessons. Nevertheless, there were some differences. And if I were to point out kind of 2 or 3 differences, was that this, first of all, was of course concentrated in advanced countries, where the policy frameworks were generally considered to be strong. Exposed, maybe we have reconsidered that. Credit growth and asset price increases were very large, maybe even larger than in the crisis we've seen in emerging markets. And the complexities and the systems were also much more greater. We saw much more interconnections, we saw much more opaqueness, we saw very intertwined institutions across borders, across various markets. And however, at the same time, what we did see is that the indicators, as we observed them, all looked very rosy. So there was a positive financial sector and soundness indicators, were also good macroeconomic indicators. So we kind of were confused as to where the world was going, but nevertheless we're setting ourselves up for a crisis that wasn't all that different from what the other crises were. However, where there were many differences is in terms of the policy responses, and I think that's where emerging markets in this time around has a lot to teach to advanced countries, because the policies that were being implemented in the advanced countries did not go as deep, and that will be the main theme of the talk here, as the ones that we had in emerging markets. In emerging markets there were much more restrictions in previous crises, and I'm talking about East Asia, I'm talking about Russia, I'm talking about Brazil and some other countries. So let me take you quickly through some of these choices. The way to easily compare that is in this kind of whatever you call it, chart, where we have the choices that were implemented in the current crisis countries allocated along different dimensions in terms of whether you impose freezes or whether you had guarantees. Compare that to the previous crisis, and the red one is the one of the recent one, and the blue one is the past one. And you see in some sense, well, the things are somewhat similar, but where two elements where things vary a lot was that this time we had a lot of guarantees. We guaranteed a lot more the liabilities of banks around the world in the crisis. At the same time, we used less asset management companies. I will get back to that. But those two distinctions were quite varying from past crises, which, as I said, were typically in emerging markets. The other dimension in which this crisis differed quite a bit from the emerging markets ones that we have seen before was all the speed at which everything happened. We saw a very quick emerging crisis, although it was building up for quite some time until we hit it in the fall of 2008. Things were kind of under the submerged of the radar screen, at least it was not being acknowledged. But once it happened all very quickly. Typically, you have a crisis where there's a liquidity problem, and then you're moving into recapitalization, restructuring phase, and the time in between the two tends to be quite long. Here it's depicted all relative to t is 0. This is the time at which we had the crisis. And then the two blue charts are the time spent, this is in quarters, between when you have a guarantee imposed and when there is a recapitalization program. Now, if you can see from the chart, that's typically quite a long period. The blue gap is quite large. This time around, the gap was quite narrow. So what happened was that in the crisis of this time around, we suddenly went from a liquidity crisis immediately to recapitalizing and restructuring banks. And just go back in your memory, in 2008, in October, we had a big liquidity crisis. In a few weeks later, we were having a TARP program. We recapitalized the banks, and we bailed out the Fannie Mae and Freddie Mac, the GSEs. So everything was kind of reduced in a very short period of time. Secondly, is that the liquidity support, which is the bars as a percentage of GDP, the amount of money that was pumped into the financial system, was a multiple of what happened in the past. So we not only dosed the fire very quickly, but also put it with liquidity very rapidly in this time around. 16% of GDP is obviously a big number if you compare that to the previous ones. The third difference was, if you compare this crisis to the emerging market one, that in emerging markets ones, typically interest rates either stayed the same or actually went up. So monetary policy was not so supportive of the financial sector turbulence that was going on. It rather actually was making it worse because the interest rate needed to go up to support the currency. So again, the blue line shows you that the interest rate as an index typically went up. Whereas in this crisis, actually the interest rates fell, as we know very well from the US, but also in Europe, in the UK, interest rates went down to 0 or very low percentage points. So we had a very different fiscal monetary response. We also had a very different fiscal response. Again, if you look at the chart on the right, typically the fiscal balance would start to, in the short run, deteriorate, but actually it would be, again, contracting, so taking demand away during the crisis period or after the crisis period. In this period, this crisis, we still have seen an expansionary fiscal policy. Now, why does it matter? It matters because both monetary and fiscal were an indirect tool to support the economies and the financial sector this time around. So rather than going through the asset management that I highlighted earlier, we now have a kind of an indirect way of supporting the financial systems in these advanced countries, very different from the emerging markets. Now, is it all that bad? If you look at the non-performing loans, no, not so necessarily so bad, in the sense that the non-performing loans in this time around, the red line again, is not increasing as rapidly. Previous crisis had a rapid rise in non-performing loans. But what you see in the other crisis is that at the end of the crisis, the loans were taking away, the non-performing loans, from the banks to asset management companies. This is the US equivalent to the RTC that was used in the SNL crisis earlier on. You take the bad loans from the bank's balance sheets and put them into an asset management company. This time around, we haven't done that. Now the question is, where does the red line go going forward? Are we still in a period in which non-performing loans will remain low, or are we up for an increase in non-performing loans going forward? In terms of overall cost, the combination of these various policies, so little direct intervention, a lot of fiscal monetary intervention, meant that the direct fiscal cost was actually low. TARP is not going to cost all that much in the US, also in other advanced countries. Actually, in the US, you may make money on TARP because you have better returns on your equity investments. But if you compare it on the other indicators, you see that this crisis was much worse in terms of an increase in public debt that was larger than before. It was also, in terms of output losses, not inconsiderate. It had a large output loss, maybe not as large as the previous crisis, where you had large declines in GDP, but this time around, what we did see was a global loss. So this is where emerging markets come in if you now take a snapshot of the state of finance today. So where are we now in the financial sector in advanced countries, and what is it going to mean for the emerging market countries? So I think the story, and you probably already anticipated, we've seen a lot of generic support to a lot of financial institutions in advanced countries. Not very discriminatory in terms of how good the company was, in terms of its management, or how strategic, how viable it was. It often was done across the board, partly to monetary, partly to fiscal policies, where there was not much of an assessment of what the viability of these institutions were, nor were there many conditions attached. One of the observations that's easy to make is that very few managers of banks have left these companies to date. You still have the same bunch of characters in many of these institutions, although they did have quite a lot of bad issues beforehand. And more generally, the restructuring is still to happen on the asset side. In the US, we're talking about the mortgage restructuring. In other countries, we talk about the corporate sector. And increasingly, we talk about sovereign restructuring. In Europe, where we have countries, and George can maybe talk more about it, like Greece, that have had some problems in terms of their viability of their fiscal and other sustainability. So we still have a long way to go. So the conclusion cannot be anything else that the state of the financial sector in advanced countries is still quite weak. We still haven't done this fundamental restructuring. We still not assured about the profitability that's there. At the same time, the sector is facing new regulations. Now, partly that's a compensation for the fact that we didn't do the restructuring well. We're still worried about these companies maybe being kind of the zombie banks that we saw before in the SNL crisis, where they go out and take too much risk because they don't have their own capital at stake. We now tend to regulate them more to prevent that kind of a circumstance. So we have a weak banking system, but a heavy regulation. And that combination, of course, is not always the best, because we're not going to encourage lending by these banks. We're not going to encourage the kind of risk-taking in a productive way. And we're not necessarily lowering also systemic risk. We still have a very concentrated banking system in most markets. Actually, concentration is probably increased. And we may also now inducing migration of systemic risk outside the banking system. The more we regulate it, but if we don't restructure it, there's of course incentives to go towards hedge funds and other kind of activities where the regulation is low, but systemic risk may still be building up. Now the same story on the restructuring is a little bit mimicked on the state of financial reform. When I say reform, is the regulatory changes, the fundamental, legal, and other changes that you would like to see, particularly after a crisis that has shown many weaknesses, you would expect to see quite a lot of reform. Here the question is, are we seeing a glass half full or glass half empty? And of course, everybody would have their different views on it. I think we have seen progress on some elements. We have seen high capital requirements. We have limits on leverage. We have a better coverage of risk. At the same time, there is a more moral hazard risk because we have supported the system so much, and because these systems have actually increased in concentration, we may find it more difficult to deal with these large institutions this time around. After all, JP Morgan has assumed 2 other banks. Citibank has taken up a bank. So everybody has increased in terms of size, and it's more difficult probably this time around to resolve them. So the ongoing agenda as a consequence is still very large, but the progress maybe is not as rapid as we would like. So just a few headings, and I'm not going to go into detail, but if you ask on market discipline, are we that much further in terms of the ability of the market to discipline these institutions by having better accounting rules, or by having more disclosure, or by having more better rating agencies? I end up with a lot of things to be determined, TBD. It's still out there whether or not we have made all the progress necessary. Same thing you can say about the regulatory governance. Clearly, failures on the regulatory side in terms of whether the agencies actually pursued their task as they were giving to them. Many of them arguably have been moved around, but where they've fundamentally been restructured is not so obvious. So in the US, we have now 7 more regulators. One has left, I think one has left, but I'm not even sure about that. But we've seen maybe less progress on the independence. This is a slide somewhere picked up from the internet as to the state of reform in the US, and it's on a whiteboard, maybe drawn by some children, as to who is fighting with whom about what, but not getting the resolution. And as I mentioned, maybe the OTS, the Office of Thrift Supervision, is gone, but we've got 7 more agencies that are now involved in regulatory issues. So, question going forward, still a lot of problems to be addressed in the US, resolution, liquidity, cross-border. Again, I'm not going to dwell on those here. These are fundamental, deep issues. From the crisis, we also have realized we need to address the shadow banking system. We need to do better surveillance, better macroprudential policies. These things are still work in progress where we can have the half full, half empty. In my mind, the half full is optimistic. This is a picture of surveillance in the European Union. This is meant to be the new structure of surveillance in the European Union. It's not obvious that this is the best system you could design. It's a little bit better because it's made by the Europeans themselves, so it's not this children that were drawing the chart, it's done professionally. But does it make you more optimistic is not obvious from the chart alone. So, in summary, the costs may have risen in terms of advanced countries, but whether the risks have gone down, it's not so obvious. And particularly, the short-run issues are still there. And one element where it hits the emerging market very, very strongly is through the what was QE2, as we now know it. It's almost over, where we have a low interest rate policy in the US that's leading to a lot of booms in emerging markets, credit booms, asset price booms in Brazil, in Turkey, and other countries. So actually they have having a lot of risk externalities being imposed on these markets because of the restructuring policies in the US and other advanced countries that, in my mind, were not first best. That did not learn from what the advanced emerging markets had gone through before. So what does it leave us in terms of finance in emerging markets? Well, I think in some sense, emerging markets mostly avoided the crisis. Now, people will say it was because of better regulation. I think that had something to do with it, but I think in my mind, a lot of it had to do with that they went through this enormous crisis before, where they did all these fundamental restructurings, ended up being more conservative, both on the banking side, on the capital market side, as well as on the regulatory side. As a consequence, the system as a whole did not go into the excesses, at least as of yet, that we have seen. The direct exposure also to the US in terms of subprime was limited. All of that has helped. It doesn't make them immune to what's happening in advanced countries, however, in the long run. And that's the thesis of where the advanced and emerging markets really intersect, besides issues like QE2, is that the cost of finance will go up for emerging markets as well. So the cross-border cost, because of the increase in capital requirements in advanced countries, will go up by several percentage points. And there will be retrenchment, as we have seen, that we saw in advanced countries to emerging markets as well. The channels are complicated. This is, don't look at it, but in the sense of the detail. But if Basel III increases the cost of finance, it will directly affect trade finance for emerging markets. It will directly affect cross-border financing that goes without a presence in emerging markets. It will also affect the presence of foreign banks in emerging markets. So through all of these channels, the net result is that you're going to face both a higher cost and a reduced supply of finance in emerging markets that they're going to have to worry about. If you try to quantify it, and this paper that I'm quoting here has tried to do that, you're talking about several percentage points of GDP. So this is percent of GDP, 0.1, 0.2, depending on the scenario you use. This paper uses 3 type scenarios, 50, 100, or 200 basis points in terms of what Basel III means for an average bank in advanced countries. How does it translate in terms of the cost of financing as a percent of GDP in emerging markets? And you see, obviously, things vary around the world. The European countries, European emerging markets tend to be the most cross-border integrated. They get most of the financing from advanced countries. So immediately any kind of an increase in the cost of finance in advanced countries translates to a large percentage point of GDP for the emerging markets in that region. Latin America, East Asia, they tend to be more self-financed, so they don't tend to be directly affected. But nevertheless, these numbers are not that small for this bunch of countries. So that's an immediate impact. And that means that there's all the more reason to increase the reforms in emerging markets. The agenda there, I think, is in some sense not new. It's largely reconfirmed. I would say the basic, as at least the World Bank, IMF, and others use it, have a good financial stability, think of the real sector, have a good legal system, have proper regulation, all that are reconfirmed for this set of countries. I don't think the crisis per se is addressing or changing of views on that. There are some, however, reform challenges for these countries that are maybe more tricky going forward. And that this particularly concerns the kind of access agenda. So broadening finance not just to the selected groups that have access to the banks or to the stock market, but making sure that small firms, low-income people, and the like have access to financing as well. And that is a broader and a more difficult issue, as we've seen in this country. It's hard to get sustainable finance to low-income countries, the subprime being, of course, the big failure in that respect. But if you think about these countries, they're even more basic of having a bank account in many of these emerging markets is not an obvious thing to get. An SME cannot get trade finance or working capital financing as easily. And there the list is large, but the key elements, I'll be brief here, is access to information, a credit bureau that shares information among people, a competitive market, making sure that we don't have the concentration that we see in some markets today. Consumer protection, it's not just about making buyer beware, but also having sanctions for people to impose. Cost of regulation, not to overdo it. Money laundering is a good example where there are very stringent requirements being imposed on people in emerging markets where they basically would like to open a bank account, but they don't happen to have the water bill or utility bill that you and I might have to present to the bank because they don't have a house. But nevertheless, they do want to open a bank account. We have to moderate the regulatory framework with the reality of these circumstances. Think of the harmonization of the rules. And good integration good is always good, obviously, but international financial integration for this set of countries has had pluses and minuses, so the balance here has to be there. So if I want to conclude here, Crisis management in the advanced countries halfway there, I would say. If you look to the lens of the emerging market perspectives, many new reforms issues have come up, yet at the same time, fundamentals have been confirmed for many of the emerging markets, but there are some own challenges in terms of banking and financial reform for this set of countries. Thank you.
Go ahead. Thank you, Stijn. George.
Yes. So, can you hear me? Am I on? Okay. Thank you all for staying that late. I know I probably will have to face the traffic on 64, but maybe I'll have a drink afterwards. It's great. Thank you, Lemma, for inviting me. It's great to be here, and Stijn also. Actually, we've been crossing paths several ways, including when I flew once to Amsterdam to give a talk there. And, you know, I'm going to actually stay away from any comments about Greece, although this is the country of origin. And all I'm going to say is that it's close to Africa. So, so I think Lemma is going to touch upon some things. Also, actually, Stijn, if you knew some of his academic work, has pointed out to some of the variables why, you know, countries, among other authors as well, why some countries succeed whereas others don't, and firms. And I think corporate governance is a key variable. So, you know, here I said I wasn't going to speak about Greece, but I did. This is what I'm going to do a little bit. This is how Darden looks, although there's a few more trees right now, and come down to Charlottesville and visit us. So what I'm going to talk about, I'm going to talk a little bit about the landscape of banking and finance in emerging markets. I'm going to talk a little bit about the evolution, how do we get here, a little bit about the risks, and hopefully give you some idea about the future. So when I spent, as Lemma said, I spent 2 years in Wall Street at Citi, and after that experience, so there's a couple of things that I took away. One is I was covering financial institutions, and I wasn't really, I didn't know as much about financial institutions. And then, of course, I realized that about 25% or a third of the essentially economy is financial institutions. And so I needed to know more about it. So I'm going to talk a lot more about financial institutions in this talk as well. As we saw, I think many of us, including many academics, realized how important financial institutions are after the crisis. And one thing I tell my students is that we realized, as much as we demonize banks, we cannot live without them, to paraphrase a commercial. And the other thing I learned in Wall Street, actually I learned it afterwards, is that when Goldman Sachs says something, I listen. And there is the first point is basically that you know, they think the emerging markets are gonna grow. Nothing really shattering, except that they think that it's the market cap, the total market cap of emerging markets is going to go up to 80 trillion by 2030, up to 14 trillion. So that's going to be about 55% of the world market capitalization in. I know it's 19 years, but they're going to go by fast, unfortunately, especially when you're getting to my age. This is something that we actually see the wave. There's this. Everybody talks about Asian IPOs. Every bank that respects itself wants to be in Asia. And in fact, we had the largest last year, the largest IPO in the world, which was the Agricultural Bank of China, 22 billion. And in 2006, we had another bank, ICBC, which I'm going to talk a little bit about, also the largest IPO. And the IPOs keep coming. Another expectation is that the largest 7 economies in emerging markets are expected to be bigger with respect to GDP than the G7 by 2020. But we have Stijn here from the IMF, so he can correct me on that. It's funny, I was talking to a student of mine who is at McKinsey. He came back for a reunion this week, and he said, China is expected to overtake the US by 2016. And I said, I have a slide that said by the end of the decade. So regardless, I think China is going to overtake the US soon. Should we be worried? I mean, we listened to some of the previous presenters. It's just, I think, psychological. I think that's what is more than anything else. But let's, I think, come to terms with the idea China is going to overtake the US. The future in the US, and this is another term, this is from a survey that PwC did on CEOs, and this is basically the part that surveyed the financial CEOs, so financial services and banks. And basically, all what they said is that, look, we gotta be in emerging markets. And there's a new term that I didn't know. It's called SAMI. It's South America, Africa, Asia, and Middle East. And basically, 61% of CEOs thought that, look, emerging markets are going to be more important than developed markets for our future. And what I find very fascinating and a trend that basically has started and it's going to continue is how, if you look at flows, they're now increasingly flows between emerging markets, as opposed to, we used to think of flows coming from the poor, the rich to the poor, so from developed to emerging. But right now, we see a lot of emerging markets to emerging markets. In fact, we see the first efforts to, in some sense, formalize the emerging markets. I think it was about 2 weeks ago or 3 weeks ago that we had the first meeting of the BRIC countries in, I think it was Hainan Island. Anyway, it's kind of the Chinese Hawaii, maybe. I haven't been there, but I'm told by some colleagues of mine it's pretty nice there. And in any event, we're going to see more of this as BRICS will try to get their voice, and they're going to be definitely a more formidable power going forward. And interestingly enough, emerging markets, we all grew up, and when I was, in the early part of the 90s, when we were talking about emerging markets, we were talking about risks, and we didn't quite talk about growth, more kind of uncertainty. And there's still, and I think, when do you know that emerging markets have emerged? When basically it's only profits and there is less risks. We haven't gotten there yet. And in my view, actually in the CEO's views, there's still this political instability lingering. They're thinking it's part of the risk that hasn't gone away. Now let me give you some nice graphs. Basically, what these graphs are gonna show you is, let's see how important are emerging markets institutions, and this graph actually can change, but that's why I like it, because it's so fluid. This is actually market based on market cap, and it's the emerging market banks that are among the top 30 in the world. And basically, you can see there that there's 9 emerging market banks that are among the top 30. So almost a third of the world banks are emerging markets. Remember, we cannot do without banks. So there is the 9 of them. And in fact, in number 1 and number 2, we have the 2 Chinese banks, ICBC and CCB, and BOC. And I know some of you kind of have never heard of them. Especially the students, I will urge you guys kind of get to know them, because they may be coming in a theater near you not too long. But interestingly enough, we got the top 3 Chinese banks plus the other 2, and then we have 3 banks from Brazil and one Russian bank among the top 30 in the world. Now, why I find this fascinating is because if I was doing the same graph for the 80s, what kinds of banks would be the most prominent among the top 30? And since at Darden we teach with case method, I'm actually kind of cold calling. So any ideas in the 80s? Very nice. So they're Japanese banks, and they, you know where they are now. What about the 90s? What about the 90s? UK? I'm not sure UK. But 2000s, okay, I'll give it away. 2000, that's easy. 2000, I think it must have been the US banks. Okay, I haven't really done it. I'm just speculating a little bit. But yeah, we went from Japanese banks. Remember, they were going to take over to US banks to now Chinese banks. That doesn't mean, of course, that, remember, the fact that China and other emerging markets are going up doesn't mean necessarily that everybody else is going down. This is sort of a similar thing. All it says is that basically 17% of the world's top 30 banks are Chinese, and 20% of the world's top 30 are US. Interestingly enough, so Chinese banks are sort of second, and Brazilian banks are sort of in the same vein as Canadian. Now, this is, of course, market caps, and they go up and down, right? So I'm going to show you a little bit in terms of assets. They don't fare as good, but they're still up there. So ICBC is number 11th with 1.7 trillion in assets. I forget where Citi is now, but you know, we used to be 3 trillion, and I say we because I work for them. But I think right now they're probably about 2 point something. I may be wrong, but there was a big, as you can imagine, big shedding of assets around the world, trying to pay for everything else. Okay, so you know, if you had invested in China, of course, you got you know, you didn't do very well during the crisis, but it looks like things have started to stabilize. This is the Shanghai Composite Index. I think what is more interesting is to see the Indian one, which actually 5,000 rupees in 1997, which I wish I don't know, I wish I had heard all of my Indian PhD friends had told me I should have put money there. I didn't, and I would have now, I don't know, 4 times the money. And I think what is interesting is that you can see that there was a much faster turnaround in the Indian stock exchange than the Chinese one. What this says is basically, actually I'm going to show it over here. This is the percent of world market capitalization in the stock markets divided between emerging markets and developed. And so in the blue graphs, you've got developed markets. In the green, you have emerging markets. And if you can see, the blue graphs go down, and the bars, and then the green ones go up, and you know, with a slight dip. But basically, the percent of world market capitalization that is now in emerging markets, it went from 12% in 2004 to almost 30% in 2009. So there's a tremendous growth in market caps. Now, somebody can say that's a bubble. I'm not sure. Okay, so all this says is that basically Indians like to list their companies in the stock exchange. So India apparently has the largest number of companies in the stock exchange, even more than the US. China keeps going up. That's sort of a metric. I was trying to write a case at some point about the different stock exchanges in emerging markets and kind of rules and regulations. And it looks like Indian having the common law system, you know, it favors that listing. But China, if you look at, this is market caps. China, this is in 2009. It's the second largest market cap in the world, eclipsing UK, Japan, etc. And this may have changed a little bit. Okay, so one thing I want to talk about right now is I want to talk a little bit about emerging market banks and how they have fared and perhaps how they will fare in the future. I think one thing that they have, look, how do banks get their money? Deposits. And of course, where do you want to be if you are a bank? You want to be in a country that basically people save. And lucky for the emerging markets banks, because they reside in countries where there's a lot of savers. And what do you pay your savers? If everybody wants to put their money in the banks, you pay them 0. And of course, that's cheap funding. Now, as opposed to developed market banks that many of them have to rely on funding in borrowing in capital markets, much more expensive. We'll see where this is going. This is kind of the status quo right now, but things are changing fast. Emerging market banks, they're doing so far pretty okay in terms of capital ratios. So they have a pretty good cushion in terms of how much equity they have. Stijn talked about the Basel III. It's again, I'm writing a case on Dodd-Frank, and the good news is that I used a JD MBA to teach me all about the rules and regulations, because I had no idea how convoluted it can be, and what that means and how long it can take or not take. And basically, we have a framework, but apparently it may take up to 240 different rulings to get the Dodd-Frank going, and who knows what's going to happen. But bottom line is the Basel III, which basically says you now have to have more equity in your balance sheet, to basically be considered Basel III compliant than before. And not only that, you could have all sorts of type of capital, like different preferreds that basically proved not to be very equity-like during the crisis. All these instruments are now gone, and I think in comparison, emerging markets are going to banks are going to fare better. And it's a relative statement in terms of Basel III than otherwise. All it says is that basically emerging market banks' share of global industry profits and dividends has gone up. It's almost like 50% in some cases. And what do they do with the money, these emerging market banks? A lot of this money goes to sovereign wealth funds and goes to the state, and basically they basically invest it in our treasuries and support our lifestyle. So that's pretty nice, and that may change though. So there was a huge growth. Last year in China, actually in 2009, there was a 32% increase in lending, and last year there was about an 18% on top of that. I think there's still a lot of growth. I mean, Tarun and others talked about, he cares about the 7 billion who don't have opportunities, and you can imagine everybody is thinking about those people. I talk a little bit about that, what to do with them. And banks think about money. How can we make money off of those? Not necessarily how can we give them access to healthcare, to free healthcare almost. I think there's still a lot of good growth at home to do business abroad. But what is very interesting, I think there's two events that are very fascinating. ICBC basically bought 20% stake in Standard Bank in South Africa in 2007. Now, if you think about it, China is all over Africa, and maybe Lemma is going to talk about this. Maybe, I don't know, maybe not. I have to admit, I haven't been to sub-Saharan Africa, so I don't know. I haven't met a Chinese person there. But all I can say is that it looks like there's quite a bit of investment, not just in Africa, but also in South America, etc. And the next, I think, more important and symbolic acquisition is happened in January of this year, where ICBC bought. They paid 140 million. That's like nothing. Remember, their market cap was like 230 something billion. Okay, so they paid 140 million in January to acquire the retail branch network of the Bank of East Asia. And that's a Hong Kong-based bank that really makes no money, but it's in California and New York. And so what that means is that for the first time, you got a mainland Chinese bank really given access to the US and being basically okayed. Now, of course, the acquisition hasn't been closed yet, but been given the okay by the US regulators. So remember what I was saying, they still have a lot of people to bank at home, but they're starting slowly to move away and outside from home. They have moved into iBanking. Everybody loves to be in iBanking in China. Actually, there's a very interesting thing. I always observe what our MBAs are doing. 10 years ago, all the bright people would basically stay here. And now you could see the reverse. So people really flock back to work for asset management companies and investment banks in China. And when I ask them why you do that, well, I'll tell you the easy answer. $120,000 or $130,000 in New York doesn't get you very far. $130,000 in Beijing gets you a little bit farther. But I know the real estate prices, and I'm going to talk about them a little bit, have started to adjust as more and more MBAs have moved back. Unfortunately, I don't look too much to the bottom 7 billion. I only look at the MBAs, but I will change my mind.
5 minutes.
5 minutes. Okay, I'm moving fast. I don't know what page I am. Okay. All this does, and I'm glad that it looks like I hadn't really talked to the other participants here, but it looks like there are connections. This is an emerging markets conference. So here I was going to talk about mobile phones and mobile banking, and it's kind of what Paul talked about, that people innovate, and they say, how can you get these people to bank? They have no bank accounts, and actually they don't have IDs. And I was reading The Economist.
We have a speaker, huh?
Huh?
You got a speaker.
I got a what?
Lemma is talking.
Oh, Lemma is talking. Okay, Lemma is trying to undo my speech. Okay. So basically, one interesting problem I found, in India, apparently, there is the Indian government is trying to give IDs to about 600 million people. There's a huge middle class that is joining every year, about 75 million in emerging markets. And of course, here's the thing. When you have people really entering the middle class, of course, as a bank, you start thinking credit cards, auto loans, and mortgages. So I think there's going to be a nice transition for the banks in there. But it's not all rosy for banks in emerging markets. Yes, they have people who save, so they give them money for free, almost. However, these people, there's constraints by the regulators, so they're going to have to put quite a bit of money with the central bank. Indian banks, for example, are required to use 25% of their deposits to buy government bonds. And I think the next thing which is interesting is that as you have the transition from savers to consumers, you will also see that people are going to put less money with the banks, and now the banks will have to go to the capital markets. This is something that actually has already started to see happening. There's still some issues about how much reserves they keep versus how much bad debts might come out. Risk management, I thought the US banks were actually at the forefront. Unfortunately, we saw that was not the case. And I think relatively speaking, they're probably much better off than emerging markets. When I see some bank trading at 2 times book, especially when you are in China, that tells me the market may have seen something that I don't like. But don't take my word, and it's not a trading tip. It's just that basically there's still risks lingering. Very quickly on PE in China, this is private equity. Basically, it's the hot market. That's kind of the bottom line. About 9% of the global funds that were raised last year, it was a China-focused fund. So basically, if you went out and you said, I'm raising a China fund, people were giving you money. Now, the problem, of course, is that where are you going to put this money? And one of the things that came out is that it's actually not very easy. Let's say, assume you employ all the Chinese MBAs so they can translate and they can look through documents, etc. It's not very easy to verify. And in fact, I was reading again that some of what the PE shops are doing is they're trying to trace receipts to make sure that the revenues different private companies are claiming are actually true. So that's what you have to do if you're an MBA going back to China, tracing receipts. But I think this may be the only way. Interestingly enough, there are some restrictions that are slowly lifted. So now insurance companies in China can actually invest into private equity. I think private equity could disintermediate some of the state banks, because if you give the money to state banks, you get zero. If you give the money to private equity, you may get a lot. I'm almost there. I have like 1 minute. I guess the biggest issue here is maybe there's a lot of unregistered funds in China, a lot of competition. You can imagine. It's considered like a hot market. Everybody's trying to get there. Carlyle, etc., all the US PE shops are there. And the question is, are there too many funds chasing too few deals? And it looks like you raise the money, but a big part of that money is actually unspent. So I'm just gonna close one more slide here. This all it says is that at the end of the day, if you are like the government of India or China, you really want to encourage some foreign banks come in, but you don't want all the foreign banks to come in and eat your lunch. So that's kind of what they do. And they're keeping foreign banks at bay in some ways. So Citi's percent was stable under 2% over the years. Morgan Stanley has managed to get in, but you have to do it through joint ventures. And but I think Symbolic also, this is the first permission that they gave since 2003 to a US bank to operate in China. There's huge iBanking fees. I'm going to close with this. Here's the sort of a laundry list of some risks. Everybody's talking about inflation. When somebody is giving you money for free, or without thinking, bad things can happen. And so we saw what happened when everybody was getting loans from everybody. So I start worrying when I see things like that. And this is kind of what happened. I mean, everybody was basically getting their money to emerging markets. And so emerging market inflation has crept up. It's about 3 times now as high as the developed markets. If you really look at food inflation, this is a lot higher. In fact, I've had also some students who are starting some very interesting food companies in emerging markets. And you could have governments raising interest rates to curb this overheating. And I think the last thing is about real estate. Everybody talks about real estate. If you go to Beijing, I haven't, but some people would say, and outside actually, there's like all these empty buildings. And there's also, on the other hand, apartments that are really expensive. And so the question is, if there is a real estate correction, what will that mean for banks and what will that mean for China? The interesting thing about China is that it's been like GE. It's been growing 10% for, 20 years. And so the question is, we've really gotten used to it. And so what will happen if that doesn't happen? So my answer is, I have no idea if there's going to be a real estate correction or not, but I can tell you that the Chinese government has now put the Chinese banks under more stringent stress tests where they actually test the scenario that real estate prices may go down to 50%. So with that, I'm going to end. Very fascinating. Go and learn about emerging markets. It's very fascinating. Thank you.
Thank you. Yeah. Thank you, George. George was talking about China overtaking the U.S. in 10 years. I don't know if you've seen this. There's a poll, a Gallup poll, that actually got reported in Wall Street Journal. 53% of the American population thinks that China has already overtaken. I mean, this is a belief system because every time they go to shop, they see all this stuff that is actually made in China. You also mentioned about Africa. Yeah, China has emerged as the largest trading partner in Africa. Just last year alone, the trading, if you add up exports, imports, they actually went up by 40%. So it's a tune of 120 billion. So their interest is not just resources. So China is not just there for the resources. They're actually in infrastructure. They are in retail. They also have in financial services. You just how they did with the Stanley Bank. So for completeness, we don't have enough time, but for completeness, I thought I should give you some introduction to Africa. So I know that Africa is viewed as pre-emerging. I got interested in African finance partly because I was born in Ethiopia. Unfortunately, Ethiopia does not have much of private finance. But I got involved with African policy institutions, the World Bank, the IMF. So I've been engaged in policy outreach relating to financial sector reforms, capital market development, and so on. And then recently I thought that maybe I can leverage, my research has been mainstream finance. I thought maybe I can actually leverage this to do some mainstream type, frontier type research in African finance. And I thought that one way to do would be to assemble a team. And so we have a team of not necessarily Africans. So we have people like Franklin Allen of the Wharton School, and then Bob Culp from the World Bank. So we have just begun doing a lot of comprehensive African finance research. I'm not going to talk about that research today because this is an introduction. I'm going to give you some stylized facts as to why you should actually pay attention to Africa. So I said next generation emerging finance. And there was a question that came up today. Somebody said, which developing countries are positioned so that they would actually end up emerging into emerging markets. And I think that one of the responses was that it was Africa. And I really believe that. So what I wanted to do is give you kind of an overview of African finance, the kinds of financial sector reforms that have actually taken place over the last 20, 15 years, and the payoffs, the payoffs to this extensive financial sector reforms. And then And then maybe I can actually appetize you, especially to those of you who are highly initiated entrepreneurs. I'm not talking about these corporate entrepreneurs or typical entrepreneurs in finance, financial entrepreneurs. And also individuals who are interested in thinking of including Africa into investment opportunities. By the way, a lot of people do not even know that there are any stock markets in Africa beyond South Africa or Egypt. And I have to tell you that some 20 of them, in fact 25. But so what I'll do is I'll just give you that overview, leave you with a catalog of things that I thought would be potentially attractive to outsiders so that they can actually view Africa in the same vein of emerging, now pre-emerging. Eventually, there will be a few countries that will actually merge into emerging markets. So, okay. First of all, a lot of people think of Africa as just one troubled country, a single troubled country. What they don't seem to appreciate is that it's a continent of 53 countries, okay? And when you have this myth of kind of lumping all these countries into one country, what you are doing is you are lumping up countries which are genuinely reforming and those which are not. And I'll tell you, I'll explain to you in a moment what the danger of doing that is. There's a lot of variation, okay, amongst countries in Africa. There are those who are actually doing very well, and there are those you always hear about which are not doing very well, like Zimbabwe, right? But there are countries which are. So, and the next question that you're going to ask is, when you say, why finance for Africa? If you go back and look at in the late 50s and post-independence era, African countries were at par or ahead of all the Asian and Latin American countries. And then we had this thing called the lost decade, okay, of the 1980s, where the rest of the world was marching forward, Africa was going backwards. And now things are actually going the other way. Things are actually moving up. Most of the African countries, on average, are growing at a faster rate than any region except for China and India now. Again, going into this question about why finance for Africa, in finance, we say the bottom line is that finance matters if it actually contributes to economic performance, economic development. There is an accumulating evidence suggesting that, in fact, that's the case. But what we see is not this growth tragedy, some people call it growth tragedy, but also a financial development gap in Africa. The way I think of financial development gap is not thinking of finance just raising capital. Finance, by the way, is not just raising capital. Finance actually involves all kinds of multiple functions. For example, if you take a bank, let me give you an example of a bank. In many African countries, there was this notion that you can set up a bank, mobilize deposits, and then channel them to the public sector. So basically, these are not informed agents, and they do this spread, and they become dysfunctional banking systems. And that is changing. And then there are some 25 stock exchanges, and some of them get set up, and somebody says, oh, now I've set up a stock exchange, so money is going to flow in. So what they don't seem to recognize is the stock exchange is for exchange of stock. So if the stock does not exchange, does not produce information, does not lead to price discovery, liquidity, governance, it's not the stock market that we're looking for. So when it comes to measures of quantity, which is like capital mobilization, quality, the quality of financial intermediation, multiple functions of stock markets, unfortunately, the gap relative to other income countries is very high. But I'm going to tell you that it's actually changing. That is, African countries have actually gone through extensive financial sector reforms, and there are stock exchanges, and there is also evidence suggesting that there is a stock market development linkage with economic development. And we know that results outside Africa, but we also have evidence now in the context of Africa. since I don't have much time, I'm going to simply tell you that I actually did, with a colleague of mine, run a bunch of regressions. That's what academics do. And then it turns out that the stuff that we found in the context of African stock markets is pretty consistent with what others have found in terms of the impact of the stock market on economic development. This is just that regression table. Now, these are the kinds of financial sector reforms that have actually taken place in Africa. Interest rate liberalization. These things were, by the way, you would actually be surprised, interest rates were controlled in the olden days. Credit was controlled. And then there have been restructuring, recapitalization of banks, privatization of state-owned enterprises, and there are a bunch of countries. This is just a categorization of countries in terms of financial sector reforms. So now, there has been a stock market boom. This is something that a lot of people are not aware about. There have been a stock market boom in Africa. So if you go back like 2 decades ago, there were only 5 in sub-Saharan Africa. Now there are about 25 stock exchanges in Africa. And one of the issues with the stock exchanges, as I mentioned earlier, is that they tend to be very thin. You don't really have much liquidity, and you don't have much action. But in order to respond to those challenges, one thing that's going on is regional consolidation of markets. So for instance, the Abidjan stock market became the first regional stock market, serving actually 9 Francophone countries. And now there are actually other regions in the Southern Africa, in Western Africa, and Eastern Africa in the process of coming up, basically pooling resources, creating synergy amongst stock markets. What happened to Africa, both in the real sector and in the financial sector, pre-crisis, because the crisis actually hit a lot of countries, including Africa, pre-crisis. What I'm going to show you is that the growth rate, I'll give you the average and I'll also give you disaggregate. The economic performance has been very, very good, very, very, very good. And not only that, the financial performance has also been good, especially in the stock market area. And so to give you the real sector results, look at this is pre-crisis, like 2007. I ended the data in 2007. So you can see that the average growth rate was close to 6%, and the average population growth in Africa is 3%. So on a per capita basis, things that actually, on average, they're actually getting wealthier. And then there has been discipline in terms of budget and debt. So you have all kinds of features that seem to suggest that things are actually improving. And then you also look at the sub-regional. The 2010 is unexpected. By the way, I just found out that they don't have the final numbers for 2010 either. So you also see on the right-hand corner the per capita income, and then you see that the average is 4.5 in 2010, and then 2.5. You know that this is actually pretty substantially higher than in the more advanced countries. Okay, so in terms of growth, there are 2 things that seem to stand out. You see, in the olden days, the growth in Africa came from resources. Being oil-rich, commodity-rich, cocoa is no longer true. It turns out that non-oil countries are also growing pretty fast. Like Ethiopia, by the way, is one of the fast-growing countries in the world. So there is diversity in terms of growth. And then, as I mentioned earlier, the growth dropped to 2.5% from around 6% because of the crisis. Now, of course, you didn't hear any bailouts. You didn't hear any bank failures because the banking system is basically plain vanilla. We didn't have these mortgage-backed securities, complex securities. We didn't have that. But now China, as I mentioned earlier, is the biggest player. Okay, so they are just number 1, and then the U.S. woke up one day and that China's overtaken Africa, and it's not just in resources. I mean, it's not even just public companies. they have private companies actually participating all over in China. Now, there are also payoffs in the financial sector. So I looked at the stock market data. If you look at the stock market data, in the stock market performance, you take a longer term, okay? Things fluctuate in the short term. So if you take a longer term, you can see that Africa actually has done pretty well. And then I started comparing these with other emerging economies. I also did that on a risk-adjusted basis. So irrespective of how you do it, the stock market performance has been very, very impressive in Africa. Now, this is a picture of the meltdown of the global financial economy, okay? And you see that a lot of these countries actually got hit. Now, the corresponding numbers for Africa is that Egypt, South Africa, which were very well integrated to the rest of the world, got hit first. And then you see that a decline in performance in stock returns. And then you can also see in terms of listing, the listing size also went down. And then you can also see in terms of market cap declines. So where I wanted, and oh, by the way, I also looked at if there's any third-party verification of what I'm saying. And it turned out that U.S. News ran a very interesting story last year, and basically arguing that Africa composite index, if you take the composite index of African stock markets, is 40%, and then you compare that with S&P 500 during that same period of minus 3%. Now, I don't want to give you the impression that everything is rosy, and there are lots of challenges facing Africa. And the biggest challenge is what I mentioned earlier, that is the private credit provision relative to other low-income countries is very, very low. So the liquidity level is very low. And then it's not really easy. It's not really easy to actually access these markets. Now, what's interesting now is that there are entrepreneurs, there are innovative guys out there who are coming up all kinds of instruments to access Africa. Okay. I'm going to go to that page and explain to you what's going on. So there are two things going on to address liquidity. One is regional cooperation of the stock exchanges. They're being consolidated. Okay, so you have regional exchanges. And the other thing that is going on is actually large-scale privatization of state-owned enterprises through stock markets. For instance, Kenya Airways got actually privatized through Nairobi Stock Exchange. So the advantage of that is that it will have an immediate impact on the depth of the Nairobi Stock Exchange. It will also lead to greater participation of Kenyans in the ownership of the Kenya Airways. I'm going to give you a disclaimer, and I'm going to give you a couple of suggestions. Because I'm in finance. I also serve on the board, so I don't want anyone to take advice from me. But if I have to give you anything, if you are really thinking of African stock exchanges, I don't want you to focus on just the major stock exchanges, like Egypt, South Africa. Things have actually changed, is that right? So you should actually start considering alternative and bold investment opportunities like Kenya, Nigeria, even Zimbabwe, by the way. you hear a lot of negatives of Zimbabwe, and Zimbabwe economy actually contracted by 70% over the last decade. But in the stock market, what you look at is a change. And apparently the more recent performance in Zimbabwe is actually pretty good. And then there are some resources to consider. You have African Stock Exchange Association. These are kind of African financial markets database. And I mentioned ETFs. ETFs are really like stocks. And what they are, they're just portfolios of African stocks traded in Europe and in the US. So the more interesting and the largest ETF is the Market Vectors Africa ETF. And actually, yes, and that actually consists of investments in Egypt, South Africa, and also 13 other African countries. And I just wanted to know how that ETF actually behaved yesterday, a couple of days ago. Because I was actually concerned that the Middle East crisis, the crisis that we're looking at the Middle East, should have an impact. So this is what I saw. So, so if the crisis began somewhere in December, and then for some strange reason, I know that there's some shock, but I didn't really see any collapse. And maybe part of the reason is that oil prices are going up through the roof, and that probably have an impact, a positive impact on what's going on in that part of the world. So for those of you who are interested in becoming financial entrepreneurs, okay, I would like to mention a couple of things, and I'm going to close. One is that most African countries are completely committed to financial sector reforms. So financial sector reforms are at the top of their agenda. But the biggest issue is capacity. So there are no capacity in terms of, there's very limited capacity in risk management, there's limited capacity in terms of accounting, there is limited capacity in terms of ratings, limited capacity in terms of research. All of which actually would end up leading to opportunities for those who are, for instance, willing to have accounting services or investment advisory services, corporate governance rating agencies, risk management services, financial education services, by the way, because one of the things I've noticed by working with Africa is that education, having talented financial manpower is an important ingredient in terms of impacting economic development. So, and then of course, I wanted to add one more thing. When this is a kind of region that have been struck by all kinds of instabilities, poverty, right? And when you invest to make money in that part of the region, you are likely to benefit in the same way as you would invest in other countries, but there's also an additional benefit of what I call social value creation. So for those of you who are interested in being good, but also doing good to others, this is one way to interface Africa. So anyway, so my purpose here is really to give you an introduction, because Africa was missing from this emerging markets for obvious reasons, because it's not emerging enough. But I think that in the future, it's very likely that countries from Africa are likely to emerge into emerging markets, and that you should be prepared. Okay. So why don't we open up for questions? Yeah.
Very interesting.
I went too fast.
Hi.
Yeah.
Hi.
Yeah.
I usually hear two different opinions. One is that China is really doing good, and it is going to overtake you. Can you hear me?
Yeah. Go ahead.
It is going to overtake United States or other, just United States very soon. And usually these scholars use a lot of economic indicators to support their argument. But at the same time, I usually hear a lot of scholars, they point out a lot of negative facts about China, saying that China has this problem and that problem. So predicting China's future becomes very interesting to me. I usually think what China will perform in the future. I think there are three possibilities. One is that China actually is really good, and it is us that worry too much about China. Another is that China does have a lot of problems, but China will keep on making progress while carrying all these problems. Or China has actually reached a point beyond which China is going to tumbling down. So I just want to consult your opinion. Thank you.
And I have you're asking me, right?
Yeah,
I have to say
mentioned China a lot,
that
so-
I'm not a China expert, although I am. We're starting just a pitch now for we're starting a new program, Global MBA, and we're gonna be spending some time there as well. All I said about China is it's really it's been impressive what it has occurred there in the last 20 years, 30 years. I've got colleagues of mine who left in the 80s and they just don't recognize their home country anymore. And even like, you know, when they go every three months later. And I guess, you know, it's very hard to predict where China is going to go. Definitely there is human capital. There is, you know, if you appeal to all the arguments which says if there's history. And to me, you know, of course, coming from a country with history, that means a lot. And I think that they're trying to go somewhere. I didn't answer your question because I don't have a right answer. It's very hard to predict. It's very hard to predict.
Good afternoon. My name's Stephen Huey. Thank you for coming today. George, I actually have another China-related question for you. You said earlier that the introduction of private equity in China has improved the ability for intermediation within markets there. Some private equity groups like Blackstone, and I think also Kleiner Perkins have introduced renminbi-denominated funds. Do you see that as improving the ability to intermediate? And if so, does the fact that there's a lot of inflation then actually detract from that ability since it's denominated in Chinese currency?
Yeah, that's a great question. I think it was the next step because they wanted to, I mean, there's a lot of money floating around and now they were sitting in the Chinese banks, and so it was an opportunity to actually get some renminbi funds invested back into China. Interestingly enough, and I didn't know that before I started looking into this, is if you're a firm in China, you can't issue yuan bonds in China. I guess what you could do, and McDonald's just did that, is to now issue yuan bonds in Hong Kong, and I think we're going to see more of that as well. So, is it a good thing? I think so. I think it's I would say probably they're going to like that in China as they're trying to see more usage of yuan versus dollar. So I think that's one thing. You're asking me about, I forget the second question was about inflation?
Yes, it was just in terms of how will inflation affect the performance of these RMB funds.
And again, you know, I'm not an economist, I'm a financial economist, so I just qualify this. I know it's hard sometimes to explain to the generalist. I'm a heart surgeon. I'm not quite like a subspecialty of the heart surgeon. So, but all I can tell you is that there's a lot of money going into emerging markets, and so unless, and maybe Stijn will wanna I'm calling Stijn now, but wanna take this. But unless there is a productive use of this money, it's gonna result to overinvestment. That's one, or basically it's gonna keep these prices, fuel these prices. So inflation has already gone up.
Let me weigh on inflation. Inflation, so the high inflation per se is not bad. Okay, so the issue really is inflation uncertainty, because what happens is that in pricing mechanisms, inflation actually gets built into nominal prices. So for instance, if the interest rate that you are demanding 3%, inflation is going to be 5%, you'll end up getting 8%. The issue is whether or not there's uncertainty around that, making it difficult for the government to manage inflation. That's what the issue is. So so it depends whether or not you are sufficiently compensated for inflation premium, or whether or not inflation is real. Okay, we talk about real versus nominal. Yeah.
Hi.
Yeah. So that's your A, actually, is that right?
Yeah, well, I want to say, and that's another way to say that, well, there's some inflation that is bad, and not sometimes there's okay inflation.
Yeah.
But I think this one is bad.
Hi. Thank you for your presentations. I have one question for Dr. Senbet.
Yes.
And one for Dr. Allayannis and Dr. Claessens. Dr. Senbet, at one point you were just saying in your presentation that the West was sleeping when China was entering Africa. My question is, why do you think the West was sleeping? Not that anybody needs any reason for sleeping. And for Dr. Allayannis and Dr. Claessens, when you were, say, young students in graduate schools, did you think or could you expect China to be rising the way that China is rising now? And for instance, when I was a student, I didn't think that I would be coming to such a forum. Everybody talking about China rising so rapidly and taking over the U.S. And if we couldn't predict it, why couldn't we predict it? And what is, wrong with our social sciences? Didn't have a sense. If you just can comment on that, because it's such a big event happening in the world, and we didn't have much.
Let me respond.
Yeah, about the sleeping issue.
Yeah, the sleeping. I think the sleeping has to do with the fact that the West did not really recognize the comparative advantage that China had. Let me explain to you what I mean. There's no traditional colonial-based hostility between China and Africa. Okay, so there's no colonial baggage. Okay, and the second is that as China was growing, one of the things that the West did not appreciate is that, remember, China has this policy of non-interference. You don't interfere. So they don't really, they take governance as exogenous, okay? So the quality of governance, such as Darfur, those kinds of issues do not matter. So they took, I regard this as a very strategic and comparative advantage in two dimensions. And then by the time China was there in a big way, they were behind. And now, by the way, everyone is trying to, India is actually trying to follow China in a big way. And so is Brazil. All the BRICS are actually following China. Africa actually is benefiting from China, not only for China, but also the positive externality that China is generating for Africa through the participation of other countries. But there's also a dark side. I don't know if you saw this, the latest Economist. The headline is a backlash against the Chinese in Africa. Okay? And so the backlash really has to do with the fact that, as I mentioned earlier, the participation is not just public companies, those are private companies. And there's a large number of actually Chinese in Africa. So there's issues of working conditions, safety issues, and also the Chinese goods actually crowding out local markets, and there's governance issues. All of a sudden, I think this is actually creating more tension. This is a little bit hyped up, but I think this shows the dark side of what's going on in terms of Chinese involvement in Africa. So those of you who are interested, actually it's one of the headline story. Yeah.
Okay.
There's.
Yeah.
Well, in terms of your broader question of did we anticipate these countries, I don't think we can claim that. But still, as economists, we always think that countries that are poor grow faster. I mean, that's just a regularity that we build into all our models. We didn't see it happening until recent in some of these emerging markets because the institutional frameworks were still weak and there was a lot of uncertainty about which way they wanted to go. So then when it actually happened, then you can include China, obviously, but you should also include Eastern Europe, where we had a political transition, Latin America that emerged from various crises. Once these pieces of the puzzle started to fall in place, the countries actually exploited the natural advantage in terms of both resources, but also importantly people, and grew the way our models, quote unquote, would tell that would be grown. That doesn't mean that it's a perfect right. They're taking risks. So back to your question about where China will go, I think Chinese leadership is very pragmatic. They understand very well the risks. They're balancing these various trade-offs. I think in emerging markets at large, there are some risks at the moment that people may be underestimating in terms of the capital flows, leading to price pressure, asset prices. Well, we talked about housing, but we can also talk about stock market. Maybe on the overvaluated side, exchange rates that are starting to become high in some countries, Turkey, Brazil, including China, Hong Kong, maybe out there. So there are risks, but again, the leadership is quite different than we had pre-90s or pre-earlier ones, and that I think gives me a lot of comfort that this trend will continue. Doesn't matter whether China is the biggest or the US, I think as George said, it's semantics, who cares? I mean, if we have a stable system, everybody can be better off, even if some countries grow faster than other countries.
I think one
yes.
more question and then we'll be done.
Oh, okay.
Yeah.
I think the disenchantment with regard to Chinese investment in Africa is very real from the people I've visited with directly and ought to be taken into account, as you just did with that Economist article. But my question does refer to Africa as far as other funds are concerned, such as the role of remittances, and also, let's say, without reference to any money that might have been attained by corruption, money that really exists there under the mattress, if you will, or having been moved to other countries, but eventually would be available for investment back home, if you will. And I think those are sources of substantial funds that over time will find their way into those economies.
I think that's actually a very good point. And this is also widely recognized in Africa now. In terms of remittances, to give you how staggering the number is, it is actually of the same proportion as direct foreign investment, or even greater, to Africa. And it is in billions. And the kind of money that those of us who are of African origin send. I mean, and so the big issue is that there's no system that actually mobilizes resources in such a way that these remittances are allocated efficiently. For instance, I send money to some village in Ethiopia. Somebody else who may not know me sending also money in that same village, but there's no system. But it's changing. So there are a number of individuals, including the IFS, IFC by the way, which are actually engaged in the business of creating funds, actually, like sovereign wealth type funds, so that resources will be pooled and will be channeled to the best use. And then the second point that you're making is that once I was looking at the capital inflows and also the aggregate debt to African countries, and it turns out that the outflow, by people like the people who are dictators, who actually channel money out of Africa, right? That money is also in the same proportion of what Africa owes the rest of the world. So the money that's actually flown illegally through corruption, through expropriation, is of the same size as the money that Africa is receiving in terms of aid. And I'm hopefully now with new technology, that new ways of tracking, you can see right away, Mubarak, for instance, is having problems, right? So I think that there will be better tracking mechanisms to actually get back potentially hugely important source of capital. And I agree with everything that you said. Okay. So I think that this will be the last question. And a show of hands for our panelists. Okay. Yeah. Great.